So the firm's invested. You do the analysis on these companies. $62 to $68 per share is the expected pricing. What do you think of that?
Absolutely. That's the right price. That's what we had valued the company at. I think this is the best time to come out. They're doing a great job. The major market, the macro market is good. IPO sentiment is good. So I think this is the right time to get out, and they're doing the right thing.
What do you think of that dual class structure, especially if their biggest competitor, who's also about to go public, Uber, doesn't have one?
Yeah, I would rather not have that than have it. But I think I understand to some extent with all these startups, they need control. But now I think the accountability bar has gone up. I think the corporate governance bar has gone up. So I think they will take a slight haircut for very traditional investors. But overall, I think it's not that big a problem. The company is executing very well. They've had good corporate governance, good corporate culture. So I don't think they have any issues like Uber did.
Santosh, explain to me how Lyft ever makes money. It's got about $2 billion in revenue 2018, nearly $1 billion in losses, sales and marketing alone about $800 million. And it seems to me like a lot of that marketing spend is just to keep the drivers engaged. How does that big expense, especially competing with Uber, the drivers are driving for both, how does that ever go down?
Yeah, so you're right. On a near-term basis, that is the right numbers. But I think a bet on investing in Uber is a bet on the future. I mean, the market is huge.
Uber and Lyft?
I'm sorry?
Uber and Lyft?
Uber and Lyft. It's still untapped, long way to go. And Lyft is predominantly focused in the United States, in North America. So I think that's untapped. The revenue per ride is much bigger in this part of the market. So I think the runway is ahead. The runway ahead is long. This company is still untapped. I mean, the market share is untapped. So I think it's going to grow over time. So at some point, they will have to calibrate their take rate and their operating expenses, and they will come to a point. But right now, it's still a top-line story. It's a gross booking story, and I think they are growing at the right. They're coming into this IPO with good momentum.
Do you have any exposure to Uber?
No, we don't have
only Lyft.
Yes, and that was a conscious decision.
Why?
Because, well, they were at that point when we started doing this. There was a lot of issues with Travis and the whole corporate culture and all that. So we thought this was a much safer bet and much clearer path to profitability down the road.
How do you expect investors to position Lyft versus Uber, assuming when they both come to market?
Yeah, I think you have to invest in both. There's going to be a different class of investors to some extent. This is a pure play with a clear path to profitability down the road, not immediately, but down the road. But it is growing very well. Uber is more, it has a lot of moving parts. We still have to see how they'll manage India and Middle East. So that's their growth markets.
But do you think people will own both who want to play?
People who like big players, who like international plays, I think they will go into Uber. Lyft is more U.S.-based or more pure play. So I think you'll see both sides, but they'll be well received. Both of them will be well received.
We had Roger McNamee on recently, and he made the argument that for either of these companies to become profitable, they may have to merge. What do you think?
Very likely down the road. We'll have to see how it plays out. But right now, like I said, the consumer transportation market is close to $2 trillion. Both these companies, they are way up there. There's going to be consolidation. They're up the stack. So they will gain a big market share. But at some point, if there is pressure for profitability and all that, I think you will see some consolidation down the road. But at this point, I think they are good to go.
Seems to me like revenue per ride, and particularly Lyft's take, Uber too, has to go up. And that either happens through squeezing the drivers or through getting the drivers to deliver food while they're delivering people or deliver packages or something like that. I mean, is that your take? And which is more likely to happen? Because it seems like there's only so far you can squeeze the drivers. Gas prices are pretty low right now. They probably won't stay that way forever.
Yes, productivity has to go up, the driver productivity, and they have to calibrate. I think down the road, a few years down, you'll have some autonomous cars in the fringes. That'll cut down on costs. They have to give more incentives, basically just increase the scope, the demand. There is way to do that, but down the road, it'll happen. Right now, they're just going everywhere, just kind of getting market share. But so they need to calibrate the take rate down the road and raise it.
How do the two differ in the relative importance of self-driving, of that unit? For whom is it more critical?
I think Lyft at this point, and they've been more aggressive than Uber has been. They've been more focused, and that's been.
You're not talking your book on this one.
No, I'm not. In fact, my research is independent of what the capital markets group does, so my opinions are different. So, but They're more focused. Right from the beginning, they have been investing very well. Their partnerships are more than Uber's, so I think they're much better focused on the autonomous side.
Finally, Lyft is kicking off what's expected to be a tsunami of these so-called tech unicorns going public this year. Pinterest, Airbnb, Palantir, possibly Postmates. It looks like you cover all of these names. What should investors expect this year, and what are you most excited about in terms of
They're all very good companies, and that's one of the big reasons. And they're all riding a secular wave, which is more renting versus buying, and rapid urbanization, and just on-demand services. So they're all riding these services, and they're the best pure play, best of breed in their own categories. So I would like all of them. I think Pinterest is a very good play. It's a ROI play. So every company has its own little kicker there, but I think they're all very well positioned.